Today's lesson will be Chapter 14, Problem 4B. As you can see on the screen, I have, hopefully you can hear me a little better now. As you can see on the screen, I have listed some terms for problem 14-4B. One of the new terms that we need to discuss is what we call callable bonds. And what callable bonds are, they are bonds that can be redeemed before their maturity date. So what that means is that companies that have issued the bonds, if they state in their bond contract that they might want to call the bonds back off the market at a later date, they can do that. And they do this by issuing what is called a call price. So bonds can be redeemed at a price that is stated in the bond contract called the call price. A lot of times this call price is stated as a percentage, and it is in this particular example that we're going to be looking at. Instead of flipping back and forth so much with Cengage during our session today, I want to just look at this Excel spreadsheet and go through the problem with you step by step on the Excel spreadsheet. I think you would be able to copy in the amounts from Cengage once we're through with looking at this particular spreadsheet. So in the first requirement, what they want you to do is journal entries. And at July 1st, they have issued 55 million of 10-year 9% callable bonds. That 9% is the contract rate of interest. That's going to be what you're going to be paying to the bondholders semi-annually, but this 9% is an annual rate. So we'll end up having to do like we did in the other problems, divide this 9% by 2 to get the semi-annual rate of 4.5%. That's the interest rate or the contract rate on the bonds. Notice it says that these are callable bonds. Pay attention to the terms in your problems. Since these are callable bonds, it means that this corporation has stated in the contract that they may want to buy back the bonds at a later date. The bonds were dated July 1st of year 1, and they had a market rate of interest or effective rate of interest of 7%. You remember this is what we found the present value of the bond issue is based on the market rate of interest. Again, this is an annual interest rate which should be divided by 2 to get the semi-annual rate to determine the present value of the bond issue. In this problem, we didn't have to find the present value of the bond issue. They're just telling you that you have received cash of $62,817,040. And so our cash account would be debited by that amount because cash is an asset and it's increasing by the amount of the cash that we received. Notice the amount of the cash that we received was more than the 55 million face value of the bond issue. What that means is it was, we received cash above the face value, and so therefore there will be a premium on bonds payable. As we've learned in previous videos, the premium on bonds payable is an adjunct account. It normally has a credit balance and will increase on the credit side. The difference between the face value of the bonds and the cash amount of the bonds will give you the premium on bonds payable. Also, we would note that there was a premium because the stated rate of interest was larger than the market rate of interest. So that means that we're selling the bonds at a premium. Since the cash amount was given to you and the face value was given to you, the easiest way to calculate the premium on bonds payable is to subtract $55,000 from the 55 million from the 62,817,040. That'll give you a difference of $7,817,040. On the next transaction that they wanted you to journalize, we've gone to the date of October 1st, and they're borrowing $450,000 by issuing a 6-year, 8% interest installment note to Intexicon Bank. The note requires annual payments of $97,342, with the first payment occurring on September 30th of year 2. So what's happened in this transaction is basically we went out and borrowed some money. We borrowed the amount of $450,000. So our cash is going to increase by $450,000. So therefore, we're going to debit our cash account. Our notes payable, which is a liability account, will be increasing. And to increase the notes payable, we would credit it. And the face amount of the note is $450,000. Notice this is an installment note, and you might want to read further about installment notes within your chapter. But what an installment note is when you borrow from the bank, you have to pay back not only the amount of that you borrowed, but you're going to have to pay back interest with that. And so the interest will be included on an installment note. But in this first transaction right here, all we have to worry about is that we've received cash and that our liabilities have gone up. And so this is the journal entry that you would have recorded on October the 1st. In our next transaction, which is December 31st, they have accrued $9,000 of interest on the installment note. You might remember from ACC 120 and Chapter 3 when we talked about adjusting entries. An accrual of interest is what we call an accrued expense. So when you make an adjusting entry for the accrued amount of the interest off of this particular note that was from October 1st, then that means that we have some interest expense that we've incurred and that we need to record in this year, but we're not going to pay that interest until the first installment date, which will be on September 30th in the next year. So at the end of each year, we have to create adjusting entries. This is an accrued expense that we are creating, and this adjusting entry will debit the interest expense for the amount of the expense that's been incurred this year so that we can put that interest expense on our income statement and match our expenses properly with our revenue on the income statement. So at the end of the year, you have to sit back and look at your ledger accounts and see if there's any accrued expenses that need to be taken care of. And this is an example of an accrued expense. Our interest expense is going to be increasing. To increase interest expense, we would debit for $9,000. Our interest payable is a liability that we've created, and to increase a liability, you would credit. On the next transaction, we're looking at another transaction on December the 31st. On December the 31st, we paid the semi-annual interest on the bonds, and the bond premium amortization of $390,852 is going to be combined with the semi-annual interest payment. We recorded some entries similar to this in a previous video, but what you're going to do is you're going to pay the semi-annual interest on the bonds. So we need to determine how we're getting the amount that we're crediting to cash or the amount that we're paying as the semi-annual interest. And this amount is taking the face value of the bonds, which is $55,000. And $55,000 is going to be multiplied by, or excuse me, 55 million is the face value of the bonds. It will be multiplied by half of the contract rate of interest, which is 4.5%. So if you take 55 million and you multiply it by 4.5%, it will give you the cash that you're paying on the December 31st transaction. Our premium on bonds payable is going to be amortized. Notice they've given you the amortization amount, but you could have also found this amount by taking the total amount of the premium on bonds payable and dividing it by the number of periods in the life of this bond. Since it was a 10-year bond, if you multiply 10 years by 2, it'll give you the number of periods in this bond, which will be 20 periods. If you divide that into the premium on bonds payable, it will give you this very same amount that they came up with here at $390,852. You really didn't have to do that in this transaction. They gave it to you, but I think it's important that you understand where this amount comes from. Then you can plug in the interest expense amount that would be debited. The difference between the cash that you paid for your interest payment and the amortization amount of the premium will leave you with this interest expense. You could use it as a plug figure. You could have also created 2 journal entries instead of the one that I have illustrated here. But Cengage seems to want to combine these entries together, so that's why I chose to state this journal entry as one compound entry. But you could have made 2 separate entries out of it, one to pay the semi-annual interest and one to record the amortization of the premium. If you made 2 separate entries out of this, your interest expense would have been debited and cash would have been credited for $2,475,000. For the amortization entry, you would have debited the premium on bonds payable and credited the interest expense for the $390,852. So you could have made 2 separate entries out of this, but Cengage again wanted you to put it as a compound entry. And so in your homework, I think you're going to have to do a compound entry. That's why I wanted to show it to you like this. And that technically is the end of the first year. In the second year, at June 30th, they're having you pay the semi-annual interest on the bonds. And the bond premium, again, of $390,852 is combined with the semi-annual interest payment. So the accounts that we debit and credit are exactly the same as the last transaction. The only difference is you're doing it on June 30th. So this would be the very same transaction that you would do every 6 months for the life of this bond. On the next transaction at September 30th, we paid the annual payment on the note, which consisted of interest of $36,000 and the principal that went toward the payment on that note is $61,342. So what we're saying here is that the entire amount of interest would have been $36,000 that you have to pay at September 30th on this note. Since we accrued interest at the end of last year as interest payable in this transaction up here, you can see that we accrued the interest. We created a liability called interest payable. We'll have to reduce that interest payable by the $9,000. So the difference between $36,000 and the $9,000 that was accrued is the interest expense that would need to be recorded at this date, September 30th. So from the previous year when we borrowed the money to this year, we're having to pay back a total amount of interest of $36,000. Since we recorded interest expense last year of $9,000, the remaining $27,000 has to be recorded in this period of time. So our interest expense is going to be debited or increased this year for $27,000. The interest payable would be decreased by debiting it for $9,000 because we're actually paying the interest from the accrual that we have stated here. So the interest payable has to go away. The note payable account also is decreasing by $61,342. That was the given amount. So if you add all of your debits together, it will give you the credit amount that you need to record to your cash account. Your cash is decreasing. To decrease an asset, we would credit. And so that's how you record the annual payment on the note that was established way back up here on October the 1st. Then at the end of year 2, at December 31st, we need to make an adjusting entry to accrue the interest on the installment note. Again, this is an accrued expense that we're talking about here. So we're going to have to debit our interest expense for the amount of interest that would have accrued from September 30th to December 31st. And the amount is $7,773. Notice this amount changed from the original entry for interest. The accrual amount was $9,000, and the reason it changed is because our note payable has decreased. So in other words, if you were keeping up with a ledger account for notes payable, which you would be doing as an accountant, you would have had $450,000 where you created the note payable. That was credited, but then when you made the first payment toward that note payable, you reduced the note payable by $61,342. The difference would be multiplied by the interest rate on the note for the number of months, and that's how they came up with this $773. But technically, you didn't have to calculate anything because they just gave it to you. All you had to know how to do is how to record the accrual of the interest expense at the end of the year. So we would debit interest expense and credit interest payable. The definition of accrued expenses is an expense that's been incurred this year. That's why we're recording the interest expense this year. This is the amount of expense in this year, which would go on the income statement. But we have to record it as a liability because we're not going to pay this interest until September 30th of the new year, when our next installment payment would be made. On the next transaction, we're paying the semi-annual interest on the bonds. The bond premium amortization is $390,852. So this journal entry here at December 31st is the very same thing that we did earlier. So you just go back and copy it, just put in your new date. It's the very same journal entry that we've done over and over again. Every time you pay interest, you do the same journal entry and you amortize. The interest and the amortization are combined together. This is the journal entry that you would make. So this is very similar to what you did earlier. Now this particular journal entry is going to take some explanation. At June 30th of year 3, we recorded the redemption of the bonds, which were called back at 1.03. Now, in your problem, they stated as 103, but this is a percentage. This is the callback percentage. They're also telling you the balance in the bond premium account is going to be this amount after payment and interest of amortization have been recorded. So technically at June 30th, you would have had another interest payment and amortization amount that you would have had to have calculated, just like this entry up above at December 31st. It just would have happened on June 30th. For some reason or another, they didn't ask you to do the amortization entry, but you have to take into consideration that that entry would have been done in order to understand how they get the balance of $6,253,632 in the bond premium account. So what I've done is I've created a T account to show you what has happened throughout this entire problem. First of all, we recorded the premium in the very first journal entry that we did on July 1st of the first year, and that premium was credited for $7,817,040. That comes from this journal entry right here. We're just posting to the ledger account. Then at the end of the first year, we recorded an amortization entry that would have affected our bonds, our premium, on our bonds. It would have been affected at December 31st, and the amount of it was $390,852. And that came from the very first December 31st amount. Right here is the premium where it was debited. So you're keeping a balance of the premium account so that you will know what's left over in the premium account as at the end of the accounting period. So on July the 1st, in the first year, on July the 1st, which probably should have been June 30th, they're going to debit the $390,852 to the T account. So this probably should have said June 30th and not July 1st. So I'm going to change that on here so you'll know what I'm talking about. Okay, and then at June 30th, we made our first, or our second amortization, because our first amortization was at the end of the first year, which was $390,892. Then on June 30th of the second year, we did the same thing again. We amortized the premium by debiting it. Remember, premiums increase on the credit side and they decrease on the debit side. So when we're decreasing this premium, we are showing that this is being amortized. So at December 31st, the end of the second year, we would amortize again, and notice it's the same amount again. And what happens is when you combine these three entries with the credit here, it leaves you with a balance at the end of the second year at $6,644,484. But notice these calculations are for the third year, so they kept going. So on June 30th, we had another instance where we would have debited the premium to amortize it, and so the remaining balance would be what they gave to you in this journal entry. So the whole purpose of showing you this ledger account, which is represented as a T account, is to show you how they got this balance here. And this would be the balance at the end of year 3. So when we call back bonds, we're really taking them back off the market. We're reducing the bonds payable by the face amount of the bond. The face amount of the bond in this case was $55 million. You'll remember that in the very first journal entry, we credited bonds payable. So when we call back the bonds, we're reducing our liabilities. So it must be debited at this date because we're redeeming our bonds. We're buying them back off of the market. You always use face value when you're recording bonds payable. The other debit was to the premium on bonds payable, and that would be for the imbalance that is left in the bonds payable account. So technically, you're taking this balance here and you're reducing it to 0. So once you debit this premium on bonds payable is going to go away. The cash amount that is credited here is determined by taking the face value of the bond issue, which was $55 million, and multiplying it by 1.03%. That's the call price. And the call price is the amount of cash that you are going to pay to redeem the bonds off of the market, to buy the bonds back off the market. So this $56,650 is the call price. Again, that is determined by taking the face value of the bonds, $55 million, and multiplying it by 1.03%. The call price is stated as a percentage, even though in this textbook they don't put a percent sign behind it. This is a percentage. It's 1.03% that they've called this back for. Once you know what your cash price is, your callback price is, or your credit to your cash account is, then you can plug this figure to find the gain on the redemption of bonds. You would add your two debits together, subtract your credit, and what's left is $4,603,632. You could use this as a plug figure, or you can determine the price of that gain. And to determine the price of the gain on the redemption of bonds, what you would have to do is you would have to subtract the call price from the carrying value of the bonds. So the call price, as we have already stated, is 56,650. That $56,650,000 is this amount as your call price, and that's where I'm getting this 56,000. The carrying value was 61,253. That's the carrying value at July 1st of the third year. And so that was really the carrying value was 61,253, 61,253,632. Again, I have tried to calculate this for you to show you how we would find the carrying value. If you know what the face value is, and you know what your balance is in your premium on bonds payable account that came from the ledger account, since the premium is added, is an adjunct account, it is added to the face value of the bonds to get the carrying value. This is the carrying value of the bonds that we would see on the balance sheet. So bonds payable would go under the long-term liability section on the balance sheet. Right underneath that, you would have added the premium on bonds payable, which was the balance when we call back the bonds themselves. And when you add the two of these together, that will give you the carrying value of the bonds. The carrying value of the bonds then is deducted, or is the carrying value of the bonds, then you will subtract the call price to get the gain on the redemption, which is this amount right here. So in other words, we backed out the call price from this 61,253,632, and that will leave you with the gain on the redemption. We'll need to put this in a journal entry to record this gain. And that journal entry is right here. So I've shown you how to calculate the gain down here. The gain on the redemption of bonds is going to be credited because that's the side that it increases on. Gains on the redemption of bonds will add to your other income on your income statement. Now, we could have possibly called back the bonds for less than the carrying value of the bonds. And if that had happened, there would have been a loss on the redemption of bonds. And losses on redemption of bonds would have been debited rather than credited. But in this case, because our carrying value was more than what we bought it back for, it gave us a gain on the redemption of the bonds. And this is how you would figure out that gain on the redemption of bonds. In the last journal entry that they wanted you to complete, the next journal entry would be on September the 30th. They're saying that you paid the second annual payment on the note, which consisted of interest of $31,093 and principal of $66,249. So again, this is the total interest expense that would have been calculated from last year at September 30th to this year at September 30th. Because we have accrued part of this at the end of December in the last year, you would have to get rid of the interest payable by debiting the amount of $7,773. That came from this journal entry right here. We're reducing the payable account, and we would subtract that 7,773 from the 31,093, and that would leave you with the interest expense that has been incurred from January 1st to September 30th. The note payable again would be decreased by the amount of the principal that is decreasing off of this note. All three of your debits would be combined together. The cash amount that you paid for that note is $97,342. In requirement number 2, on this part of the problem, they're asking you, first of all, to calculate the interest expense in year 1. So what I did is I created a ledger account that would represent the interest expense for year 1. I created this T account for you over here. So I want you to concentrate on this T account here. As you know, interest expense increases. And so at December 31st of the first year, we had a debit to our interest expense of $9,000. That debit came from this journal entry at December 31st, the end of our first year of operations. So this is where they're getting the $9,000 amount at December 31st. Then also in that same year, in the first year, we had recorded interest expense from the amount that we had recorded for the bonds that we were paying interest on. We had debited the interest expense for $2,084,148. And that's where I came up with this figure right here. So in requirement number 2, they want you to determine what was the interest expense in year 1. So I simply added the $9,000 and the $2,084,148 together to get the balance in year 1 at $2,093,148. They also, in requirement 2, wanted you to calculate the interest expense in year 2. So I created yet another interest expense account because technically they left out a journal entry. You might remember from Accounting 120 that you would have closed out the interest expense account in this year. So it's like we're starting all over and calculating the amount of interest expense that we had incurred in year 2. So in year 2, this $2,084,148 is coming from June 30th, year 2 transaction that we did up above. We also had a debit to the interest expense account on September the 30th of year 2 for $27,000. At the end of December year 2, we had another debit for the accrual of interest of $7,773. All these came from the journal entries that we've done previously. And then we had another bond interest payment where we debited our interest expense again at the end of year 2. So to get the balance at the end of year 2, I simply combined all of these debits together to get $4,203,069. That's the answer to the interest expense for year 2. Then we have another requirement, requirement 3, which is wanting you to find the carrying value at the end of the second year. And so what we would do is we'd take the face value of the bonds, which was given to us in the first journal entry. We would add to it the premium on bonds payable, which is the ledger account balance at December 31st of year 2, which was $6,644,448. That balance came from this ledger account right here. On our balance sheet, the carrying value at the end of the second year would have been $61,644,484. I got that by adding $55 million plus the premium on bonds payable, and that would give you the carrying value or the balance sheet amount that you would put on the balance sheet at year 2 of $61,644,484. And again, I just restated that in this T account, ledger account, which was already up there. I thought maybe you might want to see it again just to try to keep this clear down here as to what they've done. And so that's all of 14-4B. And this is the last video that I'll be giving you for this particular chapter. So I'm going to stop recording now. And we'll see you next time. Bye-bye.